Okay, good morning, class. And today we are actually going to start with proceed with the corporation when we were discussing about corporation. And the last class we had finished till the different theories. Today we proceed and we talk about uh, the principles of good corporate governance, right? What are the principles of good corporate governance? The first that comes up is the rights and equitable treatment of shareholders. Shareholders' rights should be given, right? Every the organization has to protect the rights of the shareholders, give respect, and should treat all the shareholders at the same level, be it a major shareholder, be it a minor shareholder. Okay, and listen to their opinions, listen to their feedbacks, and communicate to them, whether it's a major or minor, whoever it is. Interest of the other stakeholders. Interest of the other stakeholders. Uh, it's not just the shareholders, there are other stakeholders also: employees, creditors, investors, suppliers, community, customers, policymakers, can be others. So their you should recognize the obligations towards those stakeholders, so their interests, their needs has to be also taken into consideration. We have to give equal importance to all other stakeholders. Third comes up is the roles and responsibilities of the board. Board should have sufficient skills to understand, right? To understand how to run, to actually should be able to ensure to able to analyze, to able to review the performance of the management, and what they should be, the board should, for that to run the organization, to review the performance of the management, to fulfill the obligations. Then board size should be correct size, and there should be some sort of independent. They should work independently and not get carried away, and there should be full commitment from the boards. Integrity and ethical behavior. These are the two main things, which is also very crucial thing which is up there. Now, integrity is it is a very important requirement when the officers, board members are chosen. Integrity, your integrity, that is important. Like your code of conduct. Code of conduct comes into play. Yes, that's integrity. Code of conduct is very important, and also ethical behavior. When you make a decision, that should be ethical decision, and you should be responsible, ethical as well as responsible decision making. Okay, then we also have, what we have is the disclosure and transparency. Any work that the organization does, that needs to be clearly disclosed to all the stakeholders. It should be there, right? Should be, and it should be transparent. The role, whatever the work, whatever the organization, the board and management is doing, it is their responsibility to publicly disclose their work, right? And there should be transparency. Transparency also leads to, it leads to accountability. It tells who's accountable for what. If anything goes wrong, then people get to know who's responsible. If someone does something, things go good, who's responsible. Disclosure of all the important financial matters, like disclosure of matters which is essential for the shareholders, which is essential for the other stakeholders to know, has to be clearly informed. It has to be there, and it should be with true facts. Okay, next comes up is the next thing that we have is regulation. Now, regulation, you see, different countries have different types of regulatory bodies. So in US, we have so many different types of bodies out there. So what is regulation? Regulation is the administrative legislation, right? That actually talks about the rights and the responsibilities. Rights and responsibilities of an organization. It could be of 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 the government. It could be anything, but here we are talking of the corporation. So it's talking about the administrative legislation that actually talks about, that comprises of the rights and the responsibilities, right? So it could be in terms of legal regulations, could be in terms of legal restrictions, It could be self-regulatory, right? So which is there from the trade associations, social regulation, co-regulation, market regulation. Regulations can be of different types. Okay, and why is regulation? When we talk of regulation, it's important, because it's something which is talking about your conduct, right? It talks about your conduct, and if you violate some conduct, what are the sanctions that is imposed upon you? That is fine. There has to be a fine, right? So that's where the law comes into play. Very much law comes into play here, right? Okay. So what are the common types of regulation that we have? It could be on market control on market entries. It could be with regards to prices and wages. It could be with regards to the different approvals that is needed. Pollution regulations, pollution regulations. It could be with regards to employment of certain people in certain industries. With regards to standardization of products, right? With regards to military forces and services also, right? Okay. Why do we need regulations? Regulations, it's fun is basically market failures, right? Uh, Market failures can occur like what happens? Regulations due to inefficient, sometimes market failures happen because there is a monopolized, markets can get monopolized, right? Where when we talk of like public goods, like protection of the public goods, some actions needs to be taken. When information is inadequate, markets fail. When there are some uncertain unseen changes in the environment, external environment comes up, markets fail. So there has to be some sort of regulations. Regulations are needed to correct that failure in the market. Okay. So next reason is collective desires. There are regulations about collective desires, or which is sometimes considered as judgment on part of a major section of the society. Like there are diverse experiences coming up, right? Diverse experiences or are there regulation with to eliminate that, or that opportunity, eliminate or enhance the opportunity for formation of diverse preferences and beliefs. That when you have diversification, huge diversification in your preference and beliefs, that becomes problems comes up, right? And when you cannot make a proper decision, it can be harmful. So you need to have a regulation where which would help in ensuring that the desires of, there is a collective desire, like the desires of the majority of the society, what majority of the society wants, that is put into place for societal benefits. Like it could be also with regards to social subordination, where it's basically this sort of regulations aims to either to increase or reduce social subordinates of various social groups. Like when certain social groups are being tortured, their position goes down, they are being discriminated, they have been harassed, so to protect them. Endogenous preferences, right? Here it's basically for development of certain preferences on an aggregate level, like a certain group. Endogenous means a homogeneous group which has some similar preferences. So it can, like it, if it's subdued, then it's harmful also. So everyone's preferences should be given equal status. So regulations are there which would prevent the subjugation of certain groups' preferences. Okay, irreversibility. Irreversibility is where basically certain type of conduct from a certain generation, it results in where the future generations get harmed, like destruction of the environment, misutilization of the resources. So what happens? All the resources are getting misutilized and it's getting depleted. Future generations gets affected. So preventing that. Regulations can be also with regards to professional conduct of some professional bodies, right? It could be like statutory powers, contractual powers. So that's there. Interest group transfers. Yes, It's where it comes up when, due to the efforts by certain self-interest groups to redistribute wealth in their favor. So uh, what happens, like the wealth, if the wealth is in the hands of only few, then there is inequality of wealth. So the regulations actually help, the interest group transfer regulation, it helps in redistribution of wealth. That also happens. So regulations can be of various types. Okay. Next comes up is the codes of best practices. What are the best practices that the company should follow? The codes. So you see all these things are there, right? This is the model that we have. Right. So if we go into a little more details, ethics, that's the first thing. That's very much the basic needs of a business. It has to be ethical. They should align the goals, right? Align the goal. The company's goal should be aligned with that of the goals of the stakeholders. Proper strategic process should be there. The process of strategic management. There should be an effective strategic process, right? Which would take into consideration the stakeholders' values. And next comes up organization. Organization should have a proper structure which would help in effective implementation of corporate governance. Next comes up is the reporting structure. That should be such, reporting structure of the organization should be such, which would provide transparency and accountability, right? So you know what? It actually says it's the best corporate governance practice will take into consideration all the stakeholders' needs and would treat them with equal concern, equal respect. So what this is something which is very famous, which says that the best corporate governance practice implies best management practice. What is this? If a company, how do we know that a company is actually following, having a best governance, corporate governance practice? They are really following from the way the man who implements the corporate governance. It's the management. So how good is the management? Evaluate the performance of the management. If they are really doing well, if they're really effective, really efficient, which means that the organization is following good corporate governance. So this is really important. Okay, now the essence of success of business, right? What is the main essence of success? To have a clear and achievable goal. There has to be a proper strategy to achieve that, and creating an appropriate an organization which is appropriate to deliver the organization structure should be appropriate, should be which would be able to achieve that the goals, and have a strong reporting and system in place to actually monitor the progress. Okay, right. So an implementation program uh, is usually drawn up, which ensures like a which tells how the organization should fulfill the strategy to meet the interest of the various stakeholders, right? Where a reporting system should be there, transparency, regular feedback has to be there on different stakeholders, right? Then comes up is disclosure. What is disclosure? It's the procedure of releasing all the relevant facts of a company to the relevant stakeholders that influences investment decision, right? So otherwise, if you do not release these information to the public, people are not going to invest. Shareholders, existing shareholders are going to withdraw, right? Okay, so companies are, you know what? Companies are not only the entities that are subject to strict disclosure regulations. It's not just, it's a disclosure is not just for companies, it's even for law, brokerage firms, analysts, everyone. Everyone has to disclose. Wherever investment comes into play, you have to disclose because it's someone else's money that is coming into play, right? So it's very much important. Now why is it important? As we said, it's important to actually reduce all these information bubbles that's there. Like when you don't disclose, what happens, people start talking about it, people start gossiping, and that misinformation comes, and to avoid all that wrong thing and people have wrong information, right? It also helps the valuation of a firm to its fundamental value, like it does so. So it's disclosure can actually reward firms that go to the financial markets. It rewards it. If you are able to disclose your status, if you're giving, what happens? People are willing to invest, so more people are going to buy your shares, and that affects the financial markets. It helps you, right? It helps to prevent loss, right? If you can actually tell your shareholders everything, it helps you. It helps to misuse of assets, right? The investors, potential investors can actually study your accounting policies to decide whether they want to invest in your business or not, right? Okay, so what is corporate social disclosure? Corporate social disclosure, as we say, is also corporate social responsibility disclosures. It talks about the providing of information on companies' environmental and social performance other than profitability. Okay, because its profit is related with environmental aspects, with social aspects. If the company is abiding by the environmental and social aspects, profit increases, right? What is full disclosure principle? Full disclosure principle, it requires a company to provide the necessary information to all the people, so that they can actually read the financial information of the company. They are fully informed, and when they're making a decision, they make decision based on complete information. So that's why, in other words, the purpose of disclosure is to make available evidences which either supports the needs of the customer, of the shareholders, or maybe it may not be, right? It may be against also, but it's needed. It's the evidence. It either supports or undermines the respective parties' cases, either way. So it's needed. Otherwise it becomes problem. You can get trouble with the law. Okay, so what is the uh, disclosure rule, right? The regulations fair disclosure is a rule which is passed by the Securities and Exchange Commission, right? It's an effort to prevent selective disclosure by public companies to market professionals and certain shareholders. Prevents selective disclosure. Certain companies will share only information which they want to. If they don't want to, then it's problem, right? So non-intentional sharing of information must be promptly followed with public disclosures. You have to do it, right? So public disclosure is important. Why? Because what happens, like if you don't actually have these details being published, then people do not get have the full information about your company, and people are not willing to actually invest, right? So it is important for that. Okay, and the public disclosure principle, or the disclosure principle also requires that the company must report enough information in its financial statements for all outsiders to so that they can make a proper decision about the company. Okay, right? uh, what is corporate disclosure? It's procedure to communicate information about the company's performance and values to public, other outside investors and other stakeholders. So what happens? Through disclosure, there is greater transparency. Yes. So when you disclose your information, more transparency is required with regards to financial aspects and financial reporting system. It's required. Transparency is required. Provide necessary information for the investors. You want them to invest, you have to tell. Corporate Disclosure Policy Council, right? What is it? Well, Corporate Disclosure Policy Council, it looks into all those issues related to financial reporting and disclosure worldwide, right? So that's the council. It's taking care of anything regarding to the quality of financial reporting system and the disclosure. right? What do they do? They contribute to the research. They are basically up there. They are formed to meet the needs of investors and creditors by how? By promoting a set of high quality global financial standards. Also helps in the research and position papers, support the joint project on financial statement presentation. It helps to improve the accessibility and the better deliverance of the financial information, right? Okay. Uh, Next thing that comes up is reporting of corporate governance and reporting requirements, management commentary, and voluntary disclosures. The report recommends that the arrangement of companies, boards, and accounting system, they should reduce their corporate governance failures and the risks. Okay, the reporting system has to states that, and which where do we get this report from? The which it came into more prominence when the Sarbanes-Oxley Act of 2002. That from there it came out, right? Where why was this formed? Because there were senior management individuals uh, who were actually through this act, they were the ones who have been certifying the accuracy of the company's financial information. And so then came up that corporate governance reporting system has to be there. It's mandatory because there were a lot of fraud cases happening at that time, starting with Enron. Then we had other companies. So Enron was the most important one, where which started where all these problems come up and a lot of fraud cases coming up. So the corporate governance reporting is an ethically driven business process, right? Good governance principles account for. It says that there has to be good governance principles because it accounts for equity, that is equality, accountability, and transparency. So how laws and regulations have been have helped in have driven or have been driving in the formation of good corporate governance reporting system, right? How did this happen? So corporations, all those corporations which make a proper commitment, a solid commitment to ensure that they would treat the shareholders and stakeholders all alike, right? They have they are the ones they that when you say they would look alike, that means they would take into consideration the company's best interest, and that's the main thing when they make a decision, right? uh, Treating their stakeholders and all the shareholders and all other stakeholders see, look into the company's best interest when they make decision making. So these are those companies which make these commitments are the ones who are actually following a good corporate governance system. Okay, and in this respect, there was some major laws and regulations have improved corporate governance over time. So one is definitely the Cadbury report, which came in 1992. Right. So that was a first report which recommended that establishing of corporate boards and accounting systems to which would help in reducing the corporate risk and failures. The second, as we've already spoken about, is the Sarbanes-Oxley Act, which was passed in 2002, which established new auditing and financial regulations for companies. Why was it formed? To help protect shareholders, employees, and the public from any sort of accounting errors and fraud regarding the financial practices. Okay. Okay, there was another one which was the Dodd-Frank Wall Street Reform and Consumer Protection Act, right? Which came in 2010, and it created a financial regulatory process which helps in enforcing corporate transparency and accountability. Okay, in India in 2014 we had SEBI, that is Securities and Exchange Board of India, which was formed, and here basically it was formed to actually to ensure to that the shareholders approval is needed for any related party transactions. They established the concept of whistleblower policies and also increased disclosure on pay packages of the executives, and it required companies to have at least one female director on board. That came up. Okay, so this is how different countries have been bringing about changes through in the corporate governance, how changes in the corporate governance reporting system, how it can be improved upon. So these are some of the major changes that was brought about. Okay, next comes up is disclosure requirements and good governance, right? So why is disclosure required and how is it related with good governance? Disclosure requirements, right? Disclosure requirements, I mean, every organization has to go for disclosure. They have to mandatory provide disclosures, have disclosure statements related to their clients or consumers. Why is it this is basically, as we said, it's required so that people have a clear idea about the organization, so that you get more funds, and so that you're in the good books of the government, you do not fall into trouble. And so these disclosure statements, what is basically there is like it requires that you know what it requires that you should be it talks about how the document should be formatted, how often the document should be updated, right? So you have financial advisors up here who are working to make these necessary changes of the disclosure statement to address to the current clients as well as future clients. So all this is how it goes about. Okay, now this was disclosure requirements. Now, what is good governance? Good governance is what? It talks about how public institutions conduct their public affairs, manage the public resources to guarantee that the human rights are being protected, right? So, in other words, governance, it's the process of decision making and the process by which decisions are implemented, not just made but also implemented, right? So when governance comes, it could be at the business level, corporate level, international, and national level, local level, international level. It could be anything, right? So when we talk of good governance, these are the things that comes up. We've already discussed some of them: accountable, transparency, responsive, equitable, inclusive, effective, and efficient, follows the law, participatory, and consensus oriented. So, right. So what happens up here is accountable. Company has to be accountable for its work. There should be transparency in the work done. Responsible for the work that they are doing. Treating all their stakeholders at the same level, including them in when making decisions, taking their feedback. Should be running effectively and efficiently. Should follow the law of the country. Should participatory, like where decisions should be made based on involving everyone, the employees and sometimes the shareholders, also sometimes the consumers' opinion, and all the decision that is being made should be on a consensus basis, right? So what happens is when we talk of disclosure, like the actual shareholders as well as the potential shareholders, they need to have access to regular, reliable, and comparable information about the company, so in a sufficient manner to make a decision, right? That is why it's important there. So disclosure, proper disclosure will result in transparency, right? That is definitely there. Okay, so this is again a structure of how to have a proper governance with disclosure. You monitor, promote, mediate if required, monitor through participatory monitoring. Yeah, through promote the ideas, promote disclosure, diversification and dissemination of ideas, collective action, then mediate to see that if it's working properly, and then respond to the feedback. Okay, so now what happens is material information, like what when most companies actually, like let's talk, if you talk of nationwide also, they actually, when we talk of this giving disclosing information, they would actually talk of providing with material information. When we talk of material information, what is it? It's information whose omission or misstatement would influence the economic decision taken by users. So disclosure, one important fact or constituent of proper disclosure is material information, giving all those crucial information based on which can actually influence the decision of the users of that information, right? And so in developing a strong disclosure regime, right, the channels, timing and procedures for actually disseminating this information plays a vital role as along with the information. When you the media of disseminating the information, the timing, the procedures, that also plays a crucial role along with the information. If you have the right information, but if you choose the wrong media, wrong timing, and the procedure of giving that information is not correct, then it affects. It will bombard at you. It will just be a negative effect. Will have a negative effect on your organization, right? Okay. So also, like filing of statutory reports have greatly enhanced in some countries by electronic filing and data retrieval systems. Statutory reports filing has become important these days, which would help in proper disclosure, right? Uh, Today, what happens? Internet and other technologies also help in providing information to the shareholders, right? Okay. Next comes up is the mechanisms to control the managerial behavior and to enhance transparency, right? So what is when we talk of the mechanism, right? So what happens? We first have to talk about governance. Like governance, we have to just go back to again what governance is. Governance is a system to control the possible schemes to allocate the information to different participants, right? So it's a way to control the various schemes, methods for allocate for giving out information to different groups, different participants, and the different participants in the organization. Different that participants means here means the stakeholders, but again, every information cannot be given to everyone. So similar information which has to be given to same group for different the same information to different group of people. So categorize that information and then give it to different groups of people, right? So in this case, what is there? It's when we talk this governance, when we are talking about it, they are in this definition, it's basically revolving around the key executives. First comes up the governance intended to govern management decisions. Second is the decision latitude, extent of decision, the extent of decision that is made. One is with regards to management decisions. Second is to the extent of decision that is made. So that comes up. So you know what, this is when we talk of corporate governance, it takes into consideration the mechanisms that is used to control the managers, to reduce conflicts of interest, which are considered interest expensive. And so these mechanisms that we have, these mechanisms to control the behavior of the managers, to reduce the conflicts of interest, these mechanisms can be divided into two parts. One is internal mechanism, other is external mechanism. Now, internal and external mechanism, like this is a picture which shows about the internal and external mechanisms that we are talking about. Now, what happens is when we talk of an ideal control system, it should actually regulate both motivation and ability, right? It should motivate motivation of employees, ability of employees. So the mechanism and control system that we have in any organization that helps in reducing the inefficiencies that arise from moral hazards and adverse selection. So these are both internal monetary system as well as external monetary system. Okay. Internal monitoring, when we say, it can be done by one or few shareholders in case of private companies, or a firm belonging to a business group, right? Whereas on the external monitoring of the manager's behavior, it occurs when an independent third party, that is that's an external auditor, who actually monitors the performance. They look into the performance. So even you have stock analysts and debt holders can also conduct the external monitoring. Okay, so let's go into the details of the uh, internal monitoring, internal corporate governance controls, right? What is the purpose? It monitors activities and then take corrective actions to accomplish the goals of the organizations, right? Uh, and it actually, like, it's there to encourage managers to maximize the company's value. And what are the different control mechanisms? It's the monitoring by board, committees, internal control procedures, internal auditors, organizational structure, a balance of power, remuneration, and monitoring by large shareholders, or monitoring by banks and other large creditors. So let's go into these details. Monitoring by board of directors. So it's the board of director who has the right to hire, fire, compensate top level managements, safeguard the capital invested. So it's done through regular board meetings, which allows to solve problem, identify the problem, solve it, and here the role of non-executive independent non-executive directors are very much important, right? Because they give a neutral decision from a neutral perspective, right? Okay. What also happens here is like a ability, like a how. But the question that comes up is, how capable is the board in monitoring their firm's executive? It depends on the access to information. How well do they have access to right kind of information? They should have complete information to make a proper decision, right? And then to evaluate the top management. It is therefore required, right? Okay. And we know that the board of directors is one of the mechanisms of control, right? So it's a board who's responsible for the interest of the shareholders. So it is their responsibility to ensure that the shareholders' interests are protected. So the board can actually control the affairs of the company, right? They should be doing it. They can do it only when they are committed to their work. They are committed to the shareholders. They are honest. They are following ethics and making an ethical decision. And well, the main purpose of have the board having a control on the affairs of the company is, one is to verify whether the financial reports are reliable or not, and also to verify that whether the company is abiding by the rules and regulations, the laws and regulations, the Companies Act of the nation. Okay, next comes up is committees, right? There are certain committees which are formed, which is there in the board, and which committees are formed by the board, which is there, which looks after, which also takes care of the monitoring system of they monitor and control the internal mechanism, right? So they are the two most important committees that we have is the audit committee and the remuneration committee, right? Audit committee takes care of the auditing procedure to see whether all the financial statements are correct or not, and everything is, whatever is said is authentic or not. Whereas remuneration committee, when we say, that looks into the fixation of the pay structure of the executives. Okay, next comes up is the internal control procedures and internal auditors. So Internal control can also be done by the auditors, right? So when we talk of internal control procedures, we are talking of the policies that are implemented by the board of directors, audit committee, management, and other personnel, right? So internal auditors are up here to actually see how far the procedures that are implemented, the facts that are revealed, how far they are complying with the laws and regulations of the nation, whether the financial statements are reliable, whether the operation structure is efficient or not, right? Okay, so the auditor actually represents a mechanism of management control and a way to reduce the discretionary latitude that is there, right? So it's the objective of the auditor. They are the ones who provide the shareholders with all the relevant information after they do a crucial survey. It is their responsibility. Also, they do have to do that, right? What comes up is structure, property, or ownership structure or balance of power. Like this is a very strong means of controlling relations between shareholders and managers, right? So why? Because it brings together certain conditions when certain conditions are present. Certain conditions, it could be capital concentration, nature of shareholders, the basis of effective monitoring system, it brings into play. It looks after that the nature of shareholders, capital concentration, the basis of the monitoring system, incentive controllers to perform their functions, as well as cost control. So it's remuneration. It's the shareholders' money on one hand, the other side is the mechanism of internal cost control. So that's where the balance comes into play. Okay, that's where it comes. So what it actually talks about that when we were discussing about all agency theory, there were two components that comes out of the ownership structure, right? That's where we talk of the shareholders. One is the amount of money, the other is the nature of shareholders, right? So both has to be taken into consideration. So the simplest balance of power is very common. Very common. It requires that the president should be different from the treasurer. Means person who's monitoring, who's leading, who's in charge of management should be different from the one who is taking care of finance. It should be totally different thing, right? Remuneration. Performance-based remuneration is designed to ensure to relate some proportion of property of so some proportion of salary, sorry, to individual performance, right? So certain proportion of your salary should be given based on your individual performance. That's what it should be there. It should be in the form, can be in the form of cash or non-cash payments, however it is. So you perform, you get it. If you don't, you do not get it. Monitoring by large shareholders and sometimes by banks and other creditors also, right? Because they are investing a huge amount of money, right? So they have a right to control, to monitor the performance of the management. Okay, so next comes up is where we talk of the external corporate governance control, right? Which actually talks about uh, the external stakeholders, how they exercise control, right? So how are they, the control is done through the fall with uh, or it's outside the organization, it's done from outside. So what are the ways? Financial market for goods and services or competition, labor market for managers, debt governance, demand for an assessment of performance information, government regulations, managerial labor market, media pressure, takeovers. Okay, so let's go into details of all these things. Right, we start with the financial market. Now, financial market is where, you know what, today when we talk of the financial market, the control by the financial market is very important. Why? With the development of stock markets. So There is a direct relationship between efficiency, competency of managers, and the market value of the company, right? Market value of the company increases if there is efficiency in the way the company works and the managers are really competent, right? So that's a financial market which actually sees, so in the financial market, if the market value of the company is increasing, which means the company is ethical, doing a good job, managers are really competent. That's how it's been done. Market for goods and services or competition. Competition is always there, right? Competition is there. So what happens? Competition, when in a competitive market, what happens? The managers, it actually forces the managers to to optimize the management and to play a preventive role against the demise of the company. So what happens? Managers would actually start performing in a very optimized manner. They would be performing at their best to prevent the collapse of the company, because there are so many competitors to uh, prevent the company being to collapse, or prevent the company from falling down from its existing position, or there if the consumers, their own customers, go away to the competitors. To prevent that, managers actually they would be very much efficient. So competition also helps. Labor market for managers, right? This is an effective system of control. Why? Because it talks about the human capital in management. Managers are always faced with the pressure of the labor market, right? So in that case, what happens? It actually provides them an opportunity to select the best and the most efficient people, right? So that's also the labor market through the competition which exists between internal and external managers. There's competition going on, so how to their managers are always under the pressure. Like if they don't perform, what happens? Someone else takes their position. It can be someone from outside, someone from inside. So what happens? There are enough. So the existing managers, they would try to actually perform well. Debt governance. Debt governance, we are talking of the debtors and creditors who are linked with the organization, and so they have a check on the organization's activities, right? So they also have they monitor the performance and accordingly decide whether to give further loans on the, and then they accordingly actually start. If the company doesn't do well, they would actually go and demand for the return of that money. So that's another way, that pressure on the of the debtors and creditors, that's also there. Demand for and assessment of performance information, right? The shareholders have the right to know the exact financial position of the company, and they have the right to know, to go through the financial reports of the company. So that also, the financial reports has to be disclosed. That helps the shareholders to assess the performance. So that's another way. Government regulation is another thing, where the company has to abide by the rules and laws of the local government. So government also keeps a tab on these organizations. Managerial labor market. Okay, labor market. So what happens? There is enough labor, like where you have trade unions, which is there, right? Which plays an active role in controlling the activities of the company. If people are not, if the company is not doing well, what happens? The protest will come up, right? They have their own demands how the company should be functioning. So the trade these people, the laborers, they have the power to negotiate with the management if they don't do it. So trade unions or labor unions have also a power to monitor. Media plays a big role, right? So media can either help a company to really flourish, or it can pull a company down. So media also monitors how the, like the company is not doing well, it's problem. Media gets to know, and it's a big problem. Takeovers. The company doesn't do well, what happens? It's being taken, there's a possibility that it's being taken over by a bigger company. That's also there. So that's another thing. Now, in order to prevent that to happen, managers have to really perform well. Okay, we go to the next topic, that is power and influence of corporation, right? Uh, so theoretically, the authority of the corporate power is also based on accountability, right? How accountable are you with your, like, you can have power, you can have authority when you are accountable, like people would actually start believing you, and people would start relying on your decisions when you are also accountable. So what has to be done is there has to be checks and balances, so government does that. uh, you need to also be effective, you should be accountable, and you should be independent, competent, and motivated, and that is what is important, and then only can you actually exercise your power in a proper way, right? So when Carl Kaysen, right, so what he had to say, he said, according to him, there are basically three alternative modes of containing corporate power. One is asking which containing corporate power, asking whether or how corporate power can be limited or controlled, right? So one is limitation of business power through promoting more competitive markets. So business power, more competition comes up, your power, like, you cannot start become monopolized. Broader control of business powers by agencies external to business. So external stakeholders starts monitoring, controlling, then business cannot misuse their power. And institutionalization within the firm of responsibility for exercising of power. So the firm actually institutionalizes within itself the responsibility and exercise of power in the right way. So external monitoring, as having competition, as well as develop a framework by which you can actually take the responsibility of exercising power in the right way. Okay, so what should be the feasible is some, when we talk of what should be the right thing, when we talk of corporate power of corporation, there should be some mixture of the second and third type of control. What we said, like external control, as well as having the responsibility to for actually exercise the control in a right way, and which is being monitored. So accountability, when we say, it's not, it just not does not only require a mechanism, but it's also a standard, right? It is a standard which is helps in determining the maximum long-term returns of the owners. Accountability, when you're accountable, that to the owners, because to the shareholders, say the executives are accountable to the shareholders. That means what? We've learned in all the theories of corporate governance that the executives have to work in such a way so that the profits maximized. So accountability results in maximization, profit maximization. Okay, right. So corporations can give away money voluntarily, increase their workers' compensation over required, or even competitive levels, spoil their customers, act as beneficiaries in the communities where they function, right? Why? All because these activities are related to the long-term value of the enterprise. So actually doing some corporate social responsibility, increase the workers' compensation, and give some benefits to the customers or your communities when they are in need, say natural calamities or educational loans or scholarships. So what they can actually do that, right? So they can, to the extent, what they can also do is, to the extent that they can drive up, they increase the cost to make the companies costs and products and services less competitive. They can do that, but they cannot be credibly related to profit maximization. This is nothing to do with profit maximization. This is different when you are actually reducing the cost products to make it less competitive. Why? Because you want to attain the be in the good books of the society, right? Good books of your stakeholders. That has nothing to do with your profit maximization. These are two different things. One is social responsibility, other is your personal objectives. Right. So, the extent to which the corporations actually pursue their objects, they are not related to the general creation of value, right? So, and it has to be, it's a matter of both legislated and economic rules, that in the sense that profit maximization is there, but at the same time also the social responsibility. And you know why they do all these things? Why is it important? Why? So that ultimately you have more consumers, more people buying your products, more people really trusting you, so which ultimately in the long term helps in profit maximization. Okay. Okay, next we go to the next topic that we have is ethical corporation. Ethical corporation is a corporation which is following the path of ethics, which is following, when they make a decision, it's following the process of moral decision making, right? So this process actually requires the capacity to use moral reasons in decision making. When you make decisions, the morality comes into play. Also, the capacity of the decision making to control not only on the corporate acts but also on the structure of the policies and rules. So it has to, one is the moral decisions, moral reasons has to be there. Secondly, also not just the acts but also the structure of the policies and rules has to be taken into consideration. Okay. Right. So what happens if if a corporation has to be a moral agent, right? So something must have reasons for what it is being done, not simply causes, but there has to be something, uh, which has to be something moral grounds has to be done. When you do something, it's not just because you are doing it, but morality, ethics should come into play, right? So corporation is not a human being, so it cannot think like humans, but they can have reasons for when they are doing something by being morally accountable for what you are doing. That makes sense, right? Whatever you do, be accountable for what you do. So with how do you do that? You have internal control mechanism structure, so that helps you in actually analyzing your decisions, before analyzing all the situations, using the moral reasons, your behavioral aspects before you make a decision. Okay. Can companies thrive when the cost of social responsibility raises prices too high instead of making the products marketable, making them less so, right? So what happens is, basic at the end of the day, the most important things of social responsibility is to comply with the law. That's on one hand. The other hand is where we are talking of activities so unrelated to goods and services sold, uh, that purchasing them is considered by marketplace as irrelevant, right? It can be even harmful to the productivity. So what happens? Your moral aspects come into play on one hand, which results on the other hand selling of goods and services, which is not like, which if you talk of profit, which is not profitable, right? It does not give you profit, and in the marketplace, it's considered as an irrelevant one. It doesn't fit into it. If you have to think of morality, if you have to think of ethics, then you have to you cannot actually go for products and services which will give you profits. Like, you have to think that it harms your productivity. These are two contradictory things: morality, ethics, and productivity. Productivity is where you're thinking only of profit. These are contradictory, so you have to think of it, right? If you think of social responsibility, it can affect your profits also, right? From the short term, but long term it may not be so. So one of the core issues of corporate governance is who decides all this. It's the CEO of the company who decides the company's social responsibility, how it's best met, right? So CEO has to take the decision, right? Okay. So even the largest and the richest corporations need to actually assess its position constantly, and they have to make whatever changes are necessary to be competitive in nature, right? That has to be there. That's why they are in this organization. Everyone has to do it. So if you have to be there, so that's where the responsibility comes into play. Do some work which is helping the society. It's necessary. Even the topmost corporation has to do this. So there's no such thing as a good corporation that is not competitively profitable, right? Corporations are there, like they live in a world where market determines what people will buy and what they will pay, right? So it's not that a corporation that does not produce goods that people want at a price they are willing to pay has no reason to exist. So how do you ensure this? To ensure that you give your people the right goods. You cannot say that this is going to make profit, that's why I'm doing it. If people don't want it, that's then it's no use. See what people want. So do a market survey. Okay. The purpose of corporations. What is the purpose of corporations? Why are corporations being set? One is definitely for satisfaction of human wants, right? That's the customers where so to produce goods and services catering to the different parts of the society, right? Which would help to fulfill their needs. Social structure, right? Social structure, when we talk of social structure, where what happens? So it's who has created the social structure? Who has created the social structure? That's the big question that we have today. It's the human beings, us, who have created the social structure since when people were living in caves. Why? To have cooperation and specialization, right? So corporations offering which offers longer and resilient the corporations does offer the long lasting and resilient social structures. They do that, right? So to develop social structure, to have a social structure, that is really important, right? How is it being done? Like through selling of goods and services which people need, right? So what happens if you the bonding develops, people start liking your organization, they have an attachment. That's just as we say, what we say is when you have your own group of customers, customer loyalty, that's the belonging, the longingness that helps. Efficiency and efficacy, consume the corporations, right? Big corporate, they have to ensure that the the work that the people are doing, they help the people to get their things done. It could be when you are translating an idea into product, right? It could be anything. And so it helps helps corporation, gives an opportunity to the all the employees who are there to improve their level of skills, become more efficient, to actually also become more efficient and efficacy, develop their efficacy, right? Develop their skills, right? That's always a scope for it. So that what happens if you have skilled people, if you have the employees are growing, that helps you to achieve your objectives. Ubiquity and flexibility. Okay, corporations give individuals a greater and more lasting sphere of action. They have no boundaries in time or space. Okay, uh, so because corporation continues to live even with the death or retirement of its officials, it's not moved, right? So but the structure can be reformed with new people coming in. So financial structure, legal structure, so it's flexible, right? And it goes on. There can be reallocation of capital. New businesses can come up, right? So that can come up. That's also there. Identity. Identity is where we talk of the corporations' life. Corporations also have a life, even citizenship of their own, and with attendant rights and powers. Right, they have their own personality. Right, so what happens up here is corporations decide what products and services will be available, so they have their own identity, own they can make that decision. When you have your own identity, they decide investment, where to invest, they establish the workplace, they set the prices, right, they provide jobs for people. Role of Next topic, role of corporations in society, what role do they play, right? Now what happens, we need jobs, we are starting as students, you need jobs, right, you need a decent pay, right? And so who provides this? It's a corporations have a role up here to ensure that people get jobs. People get jobs when they're doing a get a decent pay, when they are doing a decent job, they are being rewarded, right? So why corporations also help in keeping the workplace and the environment safe, providing a good working environment. The environment, the natural environment also is safe, because if you do not ensure that the natural environment is also protected, so how it's done through a continuous, there's a continuous scope for growth and progress of corporations, right? And so what happens accordingly, when the corporation grows, all the stakeholders also benefited, right? So there are two connected set of laws which governs the relationship of the different stakeholders to the corporation. One is with regards to the laws that is imposed. Second is the private law established in agreement between the corporations and its stakeholders. Laws by the legislature, outside laws. Other is the private law, uh, which is building up the relationship between the corporation and its stakeholders. Okay, so government would say the government will actually steps in when the system of corporate governance cannot be assured of producing a result that is beneficial to the society. Then only government interferes in the working of a corporation. So as long as the government company or the corporation is following the rules of the abiding by the rules of the country, fulfilling the responsibilities towards the society, government doesn't involve, right? So that's again another role of the corporation, abiding by the rules and regulations, following the laws to prevent government from interfering, right? So in theory, what happens is, corporations should support the free market with less interference from government. Reality, what happens whenever government persuades, whenever the corporations persuade the government to protect them from free market, by they can do so by legislating barriers to competition or limiting their liability. They do so, right? It can happen. So actually what should happen, any corporation should first support free market where there is free entry of like competition coming up, and government should interfere. But in reality what happens, sometimes big corporate houses can have an influence on the government to protect competitors from coming in, right? So that limiting the barriers to, so whenever they can, they would actually do so, and government actually gets carried away. That also happens. So that's something against the society, right? Sometimes in society, what happens? The laws, like the laws that govern the corporations, they're designed to make it possible for them to externalize their costs. And these laws actually vary from country to country. So what happened? What do they do? Like basically to encourage more businesses, foreign business to come in. The government can go to any extent to any extent to ensure that the business houses are actually coming in. They can do any extent. to compete with the other countries. They can go up to any extent to compete with, so that business houses are actually coming in, right? They start giving extra unnecessary benefits come up. So some of the costs can be borne by the government also. That is also there. Why it's being done? Because if you have foreign companies coming in or big corporate houses, that helps in generating revenue for the government, so they will try to give some benefit. Okay, so corporations also operate under the laws of the marketplace, right? Laws of the marketplace means also known as laws of capitalism. Like, these are usually like a influence to some extent by the legislature, but it's the marketplace is the ultimate decision maker of corporate performance, right? Wherever the company is located, whatever it produces, so every decision is made by its officers, by the directors who are there. We go to the last topic for today, that is agency cost. Now this is related with the agency theory that you have studied. Now agency theory talks of the relationship between the principal and the agent. Principal is the shareholder, agents are the CEO and the directors. So it's a responsibility of the agents to work on behalf of the principal to ensure that the profits are maximized. Now when this relationship is hampered, and when the agents actually start misutilizing that money, that's where problem cost comes up. And this problem is known as agency cost. Okay, so it's a cost. Who has to bear this cost? This cost is related, it's borne by the principal, right? Principal. Because who's their money? The shareholders' money gets lost. They are being misinformed. And then that's where the problem comes up, because principal and shareholder and the agents have their own interests. Agents are having more information, the executives have more information, right? And that's where the problem is coming up. They do not give full information to the shareholders, so misinformation, right? It's a type of internal cost that arises or must be paid to an agent acting on behalf of the principal. It is coming up. Why? Because of conflict of interest between shareholders and management. Shareholders would wish the management to run the company in a way that would help in increasing the shareholder value. But what happens? Management, if they may wish to grow the company in ways that maximizes their personal power and may not be working in the interest of the shareholders. That's the problem. Earning profit in a wrong way, right? So it can the agency cost incurred due to these conflict of interest, they usually occur due to the conflict of interest between principals and the agents, right? So that's the expenses that comes up due to this disagreement, due to this conflict of interest, is known as the agency cost. That's what we have been trying. I just said so. Okay, so see this. You have the management on one side, who are the agent, shareholders who are the principal. When they have a conflict of interest, it results in agency costs. Example, common examples of principal management relationship is principal agent relationship is management and shareholder relationship. It could be politician and the voters. That also happens. That's also a really principal agent relationship, right? Now, agency costs are inevitable for any organization when principals are not completely in charge of of that organizations. So, when shareholders are not completely in charge, then what? They are not in charge. The management can do anything, right? So it can happen. Sources, the costs that is it's associated with using an agent. You know, the risk is always there when you hire someone else to do your own work. That's always there, right? So the cost of techniques used to mitigate the problems, like with using an agent, that is gathering more information on what the agent is doing, like employing mechanisms to align the interest of the agent to those of the principle. So you can have people hire people to actually see. There can be cost is there, cost In agency, one is cost of using an agent. So the second is you can also have cost. You have to bear cost for coming up with technique which would eradicate that conflict of interest, the problem which is there using an agent that can be there. So you do have these costs. One is the relationship, other is the cost of hiring someone who would prevent that prevent the problems that comes up due to conflict of interest. So two costs are there. So two categories of agency costs are there. Cost occurred when the agent uses the company's resources for their own benefit. Then problem can come up. Cost incurred by principals, okay, to prevent the agent from promoting his or herself from shareholder interest. So two ways. One, cost when the agent has more power and uses the company's resources for their own benefit, not for the benefit of the shareholders. Second, when the cost that is incurred when the shareholders prevent the management from misappropriating the funds, and where the management tries to concentrate more on their own benefits and they neglect, and the shareholders prevent them. That's it both ways. One, the shareholders cannot prevent where the management does actually. That's a cost. The other is where the shareholders prevent the management from misappropriating of the funds. So direct and indirect agency costs, right? So agency cost again can be divided into like two categories, direct and indirect. So two types of direct agency cost again can be of two types. Corporate expenditures that benefit the management team at the expense of shareholders. They're using it for the corporate expenditure, and an expenditure that arises from monitoring of management agent actions to keep the principal and agent aligned. You're spending money on monitoring the management actions, right? The first category of agency cost, where it's where the management team spends money, right? So they can book expensive hotel, but and for themselves, but that do not add any value to the shareholders. The first type. The second type, right? Then the second type could be where paying of external auditors to assess that the financial companies' financial statements are accurate. So the second type is much better, right? You're actually ensuring that the shareholders also have the authentic information. First is for your own benefit, you're spending money on hotels and all. Second is to maintain good relationship. Okay. Next, coming to indirect agency cost. They represent lost opportunities. For example, sometimes shareholders want to undertake a project which will increase the stock value, but the management team is afraid that things can go wrong, right? Which can also result in losing their jobs. So, if management does not take this project, shareholders lose an opportunity. So, this is an indirect agency cost because it arises out of shareholder management conflict, but does not have a quantifiable value. There's no money involved out there. You do not lose money, but management does not want to do it because there's a failure that the project can be. They can fail in that project, and their job will be gone. So that's indirect. Agency cost of debt. Agency cost of debt, what is it? It's the increase in the cost of debt or implementation of debt governance for the fear of the agency cost problems. Now, debt financiers in a company, they are not in control of their money, right? It's the management that the company management does. They are the ones who are in control of the money. So this situation occurs when the debt holders are afraid that the management team may engage in risky actions that benefits the shareholders more than the bondholders. So, for the fear of this potential principal agent problem of the company, debt holders may put some restriction. how the money is being used, because they feel that the money is going to be there for the helping the shareholders and not the bondholders. So they put a restraint. That's the agency cost of debt. Right. The principal agent relationship. Principal agent relationship plays a major role in agency costs, right? Because we know it's the principal agent relationship, as we discussed in agency theory, it's a relationship between the principal, that's the shareholders, and the agent, who are the executives, right? And the problems arise when the interests of both these groups are not matched. So, okay. Uh, so it's very, very important to ensure that good relationship is maintained to avoid the agency cost. Now, how do we reduce the agency cost? First is to have a good relationship between principal and agents, right? So it is really important. So in and how to do that? So in a principal agent relationship, you have to implement an incentive scheme. This incentive scheme can be financial or non-financial. Financial incentives are the common incentive schemes. It could be like, it may be decided that if a company achieves a certain goal, where management team will receive a monetary bonus. So financial incentives based on performance, what happens? That motivates the management to really work, and so everyone gets benefited, right? Stock options, it allows a person to buy a number of shares at a predetermined price. Profit sharing, that can also happen. Management gets a percentage of the company's profit, so that helps. That's one way. Financial if the management is getting it, then they would really work. Non-financial incentives, they are less commonly used and not so successful, right? Example could be new office, for giving a new office or a workplace, providing with better opportunities to the management, recognition from the co-workers, or providing with a car, right? So it's important to note that agency cost cannot be fully eliminated. You cannot do that. Incentives themselves are also agency cost. Whose money is this? It's coming from the shareholders' money, right? So what is the point of these incentives? Like, point of these incentives, if they are implemented correctly, is to lower the cost as compared to allowing management to act on his or her interest, which would incur higher costs. The purpose of incentive is only to lower this cost. Not, you cannot eradicate completely. Okay. Okay, this is a very famous case on Union Carbide and Bhopal. So this is where basically what happened was in Union Carbide factory in Bhopal. That's in India. Like they had not, due to lack of maintenance on the equipments on the, and not repairing, and not listening to the advice of the engineer. So what happened? That lead to a leakage, and leakage in the machinery, and there was a leakage of poisonous gas in the environment, and which led to actually millions of people actually becoming handicapped. There were lots who died. It was neglect of the CEO who's there. So didn't the management team, the directors did not even listen to what people were saying. So that's again conflict of interest. Conflict of interest, which led to the who suffered. It's the people, the common people who suffered. Employees have, that's the factory today is just shut down. Nobody is taking responsibility. The entire environment, the locality is still poisonous. Okay, so you can actually read more in details about it, and we will have discussion on this. Okay. Okay, that's all that we have for you. Right. If there's any question that you have, we will discuss in the next class. So see you then.